Today is Sunday, January 10th, and this is a post-market review for the stock market activities on Friday and an outlook for this upcoming week. I have the usual for you. We will discuss a lot of the news that shaped the week and will shape this upcoming week. We have macro news, sentiment news, Fed news, corporate-specific news, but we will also discuss the ban on Trump's accounts by big tech and the implications that could happen to these companies in the next few weeks. And this time around, I have the usual charts for you, but a lot more. A lot of charts that I'm watching this upcoming week. And of course, we will discuss Tesla's chart in detail. And I have a short trade idea and a protection trade idea for Tesla shareholders. So stick around for that. But for now, let's cover the market. And here we go. The Dow Industrial Average closed in the green by 56.84 points, or a gain of 0.18%. The Nasdaq closing in the green by 134.5 points, or a gain of 1.3%. The S&P 500 closing in the green by 20.89 points, or a gain of 0.55%. And here are the sectors' performances for Friday. Number 1, capturing the gold medal, consumer cyclicals. Number 2, real estate for the silver. And number 3, capturing the bronze, communication services. The laggards of the day are the inflationary trade, basic materials, energy, and industrials. We saw yields climbing on Friday, but we also saw the US dollar rising on Friday, and perhaps the US dollar will be the most important chart to watch this upcoming week. Let's contrast that with the performance for the week. And we see that energy at number 1 for the gold, the silver in the second place goes to basic materials, and the bronze, the third place, goes to healthcare. So all in all, for the week, the inflationary trade overperformed. However, on Friday, we saw a little bit of a give back and perhaps a little teaser of what's about to take place this upcoming week. Moving on, the futures market performance on Friday, and right away we see the crude oil had a massive day to the upside regardless of the rise of the US dollar. And remember what we said last time around, the US dollar traded in the green. Meanwhile, metals like gold and silver also traded in the green. And I said at that time that you have to be very careful here because it could be the case that metals are lagging in reaction to what's going on with the US dollar. And right away, you see what's going on in metals during Friday's session. Gold down big, silver, platinum, palladium, all down significantly. Exception is copper, but copper will get hit as well if we continue to see the short covering rally in the US dollar intensifying. So the take here, we could see crude oil prices peaking in the short term here as we see the US dollar rallying higher. But it is a lagging reaction. We did not see that on Friday, but we could see crude oil tumbling this upcoming week. What's going on with softs? We see a down day for coca, OJ, lumber, and it is very important to watch the chart of lumber because it is a very good indicator for the direction of the stock market. When we saw lumber prices rising significantly early in the summer, that was the canary in the coal mine that stocks are going to rally as well. And as soon as we saw lumber prices breaking down, that was the indicator that the stock market will hit the brakes in September. And you saw what happened. We saw lumber prices rising again, and immediately stocks followed through, and we saw a rally out of the consolidation that we saw in the fall for stocks. So now that lumber prices are diving down, is this the leading indicator that stocks about to dive down as well? We shall see. But here it is. We saw coffee rallying on Friday's session. Meanwhile, the action in meats was negative, pretty much everything down about 0.5 percentage point or so. Moving on to grains. What's going on here? Soybeans, soybean meal, all closing in the green. Corn, the rally goes on. However, we're seeing a little bit of consolidation here in corn. Oats, a resumption of the rally, almost up 1% for the session. Meanwhile, a big decline for canola, down over 2%. Canola been outperforming for a while, and it is about time to take a break. Moving on to the big casino. the options market. Let's see what happened on Friday. The busiest table coming up number 1, Tesla, with over 1.8 million contracts traded for the session. About 55% of those are calls. Now, please pay attention here because we're trying to hunt for a top for Tesla. Remember what I said a few days ago, we saw 2.5 million contracts traded for Tesla. And I said, watch how the options volume is going to recede in the next few days and how the put to call ratio is going to change. If we continue to see the options volume in Tesla receding and we continue to see the put to call ratio for the name improving, meaning more puts are being bought, that would be your leading indicator that we are reaching a top in Tesla. And perhaps we already did. We'll talk about Tesla a little more during the charts analysis. But for now, let's visit the second hottest table on Friday for Apple, with over 1.7 million contracts traded for the session. Over 71% of those were calls. NEO, number 3 per usual, about 1.4 million contracts traded for the name, and over 74.5% of those were calls. Moving on to the unusual trades for the day. And the first trade, right away you can see it for the Qs, and it is a protection trade, aka a bearish trade. They're opening a spread here by buying the 295 puts with expiration date for January 26, and they are paying about $4.85 to enter this trade. The expectation here, of course, that the Qs will decline over 7.5% by then. Meanwhile, they're also selling the 280 puts, same expiration date, February 26, and they are collecting about $2.85 a piece. All in all, bringing the total entry cost for this trade to about $2 a piece. Now remember that the first quarter of the year is usually the worst for the stock market, historically speaking. So a trade like this makes a lot of sense. Your entry cost is $2 a piece, and your maximum gains in case the trade works your way will be about $15 a piece. The risk versus reward here is very worth it, and right now is extremely low, meaning the put prices are very cheap and you should be taking advantage by buying some protection for the downside here. Here is another interesting trade for the ticker AU. Anglo Gold, and this is a gold mining company. They're buying the 25 calls, expiration date February 19th, with the expectation that the name would rally over 7% by then, and they are paying about $1.20 for this trade, bringing the total to over $2 million. Now, pay a little bit of attention here. We see a bullish bet for gold. Gold has been underperforming throughout this inflationary trade that we're seeing, but copper has been overperforming. We're about to see the opposite happen. Perhaps gold will see more pain, but the moral of the story is that copper will decline as well. We'll join gold in the declines if we see a rise in the US dollar. So what are they doing here in the short term? For the ticker FCX Freeport McMoran, they are buying the 29 puts, expiration date by the end of the week, January 15th, and they are paying about 20 cents a piece to enter this trade. So perhaps the short covering rally in the US dollar will intensify this week, and we will see declines in materials, industrials, energy names, etc. The inflationary trade has to give back a little bit, but perhaps by February we will see the inflationary trade regaining momentum once again. Now, let's talk about the ticker PCG, and this is for PG&E Corporation. This is a utilities company, matter of fact, a criminal company here in California. They cause a lot of wildfires, etc., but they are hunky-dory with the government of California. They make sure that they make the donations to the politicians, and the politicians cover up for their crimes. With that being said, we have a trade here for the name, and they are pretty much a holder of PG&E. This is the way I read the trade. And they are buying the 11.5 puts, expiration date January 29th. And they are paying about 20 cents a piece for this trade. At the same time, they are selling an upside call, the 13 call, and they are collecting about $16 a piece. All in all, lowering the entry cost to about 5 cents a piece. What does that tell you? It is a holder of PCG, and they are anticipating a correction in the name here, so they are buying the puts, and at the same time they're raising cash from selling the calls because they're expecting that the name is going to decline and even if it rallies instead, they're okay with selling some shares at the price of $13. Moving on to the ticker double D for DuPont. Here's another material name for chemicals, and they are making a bearish bet here, buying the 75 puts, expiration date February 19th, with expectation that the name will decline over 8% by then, and they are paying about $2 a piece to enter this trade, bringing the total to about $2 million. And of course, you can't help but to see the trade for Tesla. This is a bearish trade. They're buying puts, specifically the 770 puts, with expiration date January 29th, with expectation that the name will decline over 12.5% by then, and they are paying big bucks for it, about $31 a piece, bringing the total to over $27 million. So again, this is somebody who's either buying protection for Tesla or they're making a short bet against Tesla by the tune of over $27 million. We know that Michael Burry, the big short, is shorting Tesla, and he added to his short this week. So perhaps this is one of his trades. We don't know. What about Carvana? The ticker CVNA, they're buying puts, the 230 puts, expiration date February 19th, the expectation that the name will decline over 17.5%. Massive decline. And they are paying massive entry cost here to enter the trade, about $7.5, bringing the total to over $57 million. This is a massive bet against Carvana, and you cannot help but to pay attention to this trade. And perhaps some of the big hedge fund managers will come over at CNBC or Bloomberg or whatever, and they will reveal that they are behind this trade. Nobody's going to commit big bucks over $50 million shorting Carvana without knowing in advance that this name will decline for certain by expiration date. What do I do when I see a trade like this? I will follow it, but this is a little too expensive for my taste to pay $7, so I will structure it in another way, perhaps buy further away in the money or turning it into a spread, etc. And here is the last trade I want to show you for the ticker MARA. And this is for Marathon Patent, and this is a crypto company for blockchain, whatever that dark word is. And they're buying a 23 puts, expiration date January 15th. This upcoming week, they're paying big bucks for it, about $2.50, bringing the total to about $2 million. Now, as I'm doing the recording for this video, I'm seeing that Bitcoin has declined significantly from the top, from the highs of the weekend. Every weekend we see a surge in Bitcoin, pump, and then a dump. Is this going to be different here, where we don't see a follow-up during the trading week, and this is a top for Bitcoin? Certainly a trade like this for Mara will be rewarded handsomely if we see a decline in Bitcoin during the trading week. Moving on to the headlines that shaped the day, and starting with macro news, the biggest piece of data we got in the morning on Friday was the December jobs report, and it was an epic disaster here, much weaker than expected. We were expecting to create over 50,000 jobs in December. Instead, we lost 140,000 jobs. A massive mess and an indication that we are running out of steam in this recovery and we are heading lower. More pain to come here without further intervention from the government, aka a new round of stimulus, and for the vaccine deployment to work better than expected. And the bulk of the losses came from restaurants and bars. Here it is. Restaurants and bars drove the jobs decline last month by cutting 372,000 jobs, the Labor Department said Friday. And of course, how did the market react to this extremely negative news? By rallying higher. And perhaps this is the reason why. And I told you ahead of time, if we have a bad report, stocks would rally because they will expect more cocaine in the form of fiscal and monetary stimulus. And here it is. Biden considering 1-2 stimulus punch, 2,000 stimulus checks plus 3 trillion tax and infrastructure package. This is according to Axios. And right away you saw the market not paying attention whatsoever to the weakness in the jobs report and being fixated on the potential of more cocaine instead. With that being said, we had a little bit of an emotional roller coaster on Friday, and here is the reason behind that. Remember the whole Manchin optimism I talked to you about before the Georgia elections? Here it is, the most important man in Washington, D.C. right now, Senator Joe Manchin of West Virginia. And he said it absolutely opposed Biden's stimulus check, then swiftly walks it back after stocks tank. I think now you know where your beloved politicians' priorities are. They could give a rat's ass about you. The only thing they care about is stocks and corporate America. Because you see Senator Manchin right there, taking his mask off and talking on the phone. Who do you think he's talking to? His donors, corporate America. And they're telling him, boy, you better pass that stimulus because we need more cocaine in the market for our stocks to go up so we can get richer in the process. Now, Senator Manchin is in a tough spot here because he has to thread the needle between pleasing his donors and pleasing his base. West Virginia is a Republican state, or a conservative state, but they continue to vote for Joe Manchin, a Democrat, because he is, quote unquote, a conservative Democrat. We will see how this saga will end, whether Manchin is just bluffing and trying to make himself feel more important than what he already is, or if he is serious. And if he is serious, the market will throw a fit because Manchin will put a halt to stimulus optimism. But rest assured, the market would rally anyways, because if Senator Manchin can put a halt to the stimulus, he can also put a halt to any potential for tax increases. Moving on to Fed news, and let's talk about the Federal Reserve, specifically Chicago Fed President Evans. And boy, they put this guy on overdrive this week. He's been giving interview after interview, speech after speech. And in this case, Chicago Fed President Charles Evans says that the U.S. Central Bank should not be shy about letting inflation run, as it has promised, above its 2% target in order to make up for years of undershooting that goal. Remember that we have people losing their jobs, their income. We're registering about 800,000 people every single week applying for unemployment status. Amidst all of that, the Fed thinks that letting inflation go higher is a great idea, further strangling and choking the poor and the middle class to death. Now remember, inflation is already here. All you have to do is go to the grocery store and take a look at food prices. Even tuna cans are now sold for $2 a piece. It's absolute insanity, but the Federal Reserve does not count food prices as part of their formula for calculating inflation, because food prices can vary a lot more than other commodities. Okay, so what is the most important thing you guys at the Fed look at when you consider inflation? Here it is. Are you ready for it? Wages. God forbid your wages go higher. Then they will say inflation is going a lot higher and we have to put a stop to that, and they will increase their interest rates. Back to Evans here, and pay attention because I think that Charles Evans took some of the stuff that St. Louis Fed President James Bullard is taking. Here he is. Fed Evans says probably 2024 before rates start to rise. Okay, so we need inflation to run well above 2%, and we're not going to raise rates until 2024. Okay, what's next? And I think that Chicago Fed President Evans is having somewhat of an emotional roller coaster here, because here is his next statement. If got 3% inflation, that would not be so bad, and it's very difficult to imagine out of control inflation. Mr. Chicago Fed President Evans, you don't need to imagine anything. Inflation is already here, and getting to 3% inflation will be disastrous for the stock market at least, and it will choke the poor and the middle class further, and it will perhaps destroy the U.S. currency. Remember that your boy Jerome Powell, Papa Jerome, the Fed Reserve Chairman, said that stocks are overvalued from a PE ratio perspective, meaning that stocks are too expensive to his taste. But you have to put things into perspective, that stocks are cheap once you factor in that we have the 10 years treasury yield continuing to trend lower. What did we see since the beginning of this year? The 10 years treasury yield surging higher, not lower. So here is Evans with the confusion once again, trying to outlay his insurance policy. So in case things get out of hand, the bubble pops, or we have another crash, hey, it's not our responsibility. This is what Chicago Fed President Evans is saying, quote unquote, financial stability objectives are best addressed through supervision and regulation rather than through monetary policy tools. Meaning, if we see the bubble inflating higher, then popping, causing a market crash, etc. That is not on our lap, the Federal Reserve. That is on the lap of regulators. He's trying to wash away the responsibility of the Fed from what's about to happen in the stock market. And by the way, the Federal Reserve is a very confused organization. I keep saying that over and over again. On one hand, they're saying that we are abandoning the Phillips curve, but at the same time, they want inflation to rise higher because that will mean lower unemployment rate. So are you guys abandoning the Phillips curve or are you not? They have no clue. They want to increase money supply to insanity, but somehow they want to keep the US dollar stable. They want inflation to rise, but somehow they want the 10 years treasury yield to remain lower. Not gonna happen. The Fed has no clue what they're doing. They did this grand experiment, flooding the market with an insane amount of liquidity, a tsunami of liquidity. It's all an experiment, and they realize that they have overdone it. And by the way, just to illustrate to you how fragile the stock market is, remember the whole argument about, yes, stocks are expensive, but you have to put them in perspective in regards of the 10 years treasury yield. Well, here it is. The 10-year yield has moved above 1%. S&P 500 earnings yield compared to the 10-year treasury now at the lowest level since November 2018, meaning that the argument that your boy Papa Jerome gave you to continue to buy stocks and to gamble because the 10 years treasury yield will remain low, that argument is already out of the window. The recent surge in the 10 years treasury yield made taking the risk with these high stock valuations not worth it anymore. You cannot justify these high multiples in stocks by saying the treasury yield is too low. Going over 1% was enough to kill this argument. Can you imagine what will happen if the 10 years treasury yield surged to 2 or 3%? And by the way, do you guys remember what took place in November 2018? I think you can answer that question for yourself. And here is the admission. The St. Louis Fed issued this tweet saying that U.S. stock prices have roughly doubled in the past 7 years and tripled in the past 10 years. What might be the outlook in the long term? And here's a tweet from Sven Henrich. In keeping with its mandate, the Fed is concerned about investors losing money. He caught a good one here from the St. Louis Fed. These are the words of the Federal Reserve. Not my words and not Sven's words either. Pay attention. Quote unquote. Asset prices that substantially exceed fundamental values often concern central bankers because large negative returns caused by a price correction will create losses for some investors. Oh, how generous of you to acknowledge that, St. Louis Federal Reserve. All of you amateur investors and young investors, new investors who joined the market last year after the bottom in March. And you keep saying, oh, don't worry about the valuations, don't take profits, stocks are going to go to the moon, bro. Because the Fed, here is the Fed telling you, we cannot prevent price corrections in equities, and some investors will face losses. Are you paying attention or not? The likelihood is you're not, because you're too indulged in this bubble. NEO this, Palantir that, Snowflake this, Airbnb that. We'll see how that's going to end for you. And you guys keep saying, oh, but the market keeps looking forward. Yes, we have the COVID-19 and all the problems with employment, etc., etc., but the market keeps looking forward. Well, according to Wall Street experts, the market looks about 9 months forward. What do we have about 9 months from now? Here it is. The Fed could start pulling back on support next year. What that means for stocks. And you heard from Atlanta Fed President Boystick admitting that they will taper their bonds purchases. So if the market is looking forward 9 months or so, then in February and March of this year, the market should see that the cocaine from the Federal Reserve will be interrupted. What do you think will happen to the stock market when it realizes that this whole liquidity tsunami is coming to an end? And by the way, that end could come abruptly if inflation continues to rise beyond control this year. Moving on to market sentiment news, and here it is. Bank of America recommends selling equities as vaccines hit the market, points to frothy prices and greedy positioning. And here is the note from Bank of America. Sell the vaccine, frothy prices, greedy positioning, inflationary and desperate policymakers, peaky China, and consumer all ultimately toxic brew in 2021. We continue to say Q1 sell the vaccine on peak positioning, policy profits, thus far premature call as weak vaccine rollout, blue wave, and Powell/Yellen gravy give investors free call option for risk. The 3 Ps. Number 1, peak positioning, likely February and March, signaled via Bank of America bull and bear indicator. Are you paying attention or not? February and March. The market's going to look forward to what? The end of the cocaine operation. Here's a Bank of America telling you peak positioning. The second P, peak policy signal via through credit spreads. Note correlation with cash as percentage of equity market cap. Chart 10, whatever that chart is, doesn't matter. Likely March, April. 3, this is the third P, peak profits. Likely April/May. When year-over-year macro will be strongest in years. The market rallies during the times of weak economic data, crisis, chaos, pandemic, but it will crash during times when the economy is actually doing better, unemployment is getting better, corporate earnings are recovering. Why is that? Because this stock market is a cocaine addict. It does not care about the real economy or corporate earnings. It cares about one thing: the cocaine. What is the cocaine? Number 1, fiscal liquidity. Number 2, monetary liquidity. That is the most important one. Monetary liquidity from the Federal Reserve. If you have an economy that is improving, then the liquidity goes out of the window. It's not needed anymore. Stocks will crash and suffer a withdrawal. More in sentiment news. The Buffett indicator, global market cap divided by global GDP, is at all times highs. The last time we saw that, it happened just before the financial crisis in 08-09. Are you paying attention or not? Probability is you're not. Speaking of bubbles, here it is. Bitcoin, is it the mother of all bubbles? And this is from Bank of America, and they compare it to the biotech bubble, the FANG bubble, the China bubble, US housing bubble, even the dot-com bubble, and the gold bubble in the 70s. Bitcoin bubble dwarf them all. It is the largest bubble in human history. How do you think this movie will end? There is more information about the insanity of the current market sentiment, the call options gambling mania. Take a look at equity calls and the surge since the March bottom. The new entrants to the market, who we call the Robin Hoodiots, have discovered options. And in their thinking, stocks only go up. There are no red days. And if there are red days, there are opportunity to buy. And you don't need to bother with valuations or fundamentals. Buy first, ask questions later. Matter of fact, don't ask questions. And what they're doing is gambling every single week with call options out of the money, thinking that they have uncovered a gold mine, the easiest way to become rich, not knowing that this is gonna work until it doesn't. And when it doesn't, you're gonna lose everything. You can see that the call options gambling mania is the primary driver of the current market move, meaning that we have an equity market that continues to rally higher and higher every day based on the action on the derivatives market. Do you think this is sustainable? Think again. What happens when all of these option sellers become bloated because they have to buy the stock to continue to sell you these call options? At some point, they've made enough profits, insane profits, and they will decide to dump on the heads of call options buyers to make sure that they lose all their money. And this one will be an epic one because the process of accumulation is extremely crowded. just take a look at Tesla, Palantir, Neo, etc. There's a huge surge in positioning from option sellers. They're not interested in holding these names forever. They're just interested to hold them to continue to sell call options and participate in this call options mania to get richer. And at some point, when things get out of whack, remember, they're not buying these stocks as an investment. They're not in love with these names. They're buying it to be opportunists. And once that opportunity is over, they will dump severely. And here is the last bit of information regarding market sentiment that I want to share with you. The Russell 2000 performance pinned to the NASDAQ, and it is reading at all times highs. Every time we reach these levels, we saw a market crash. We saw the Russell outperforming the NASDAQ in 2009, just before the crash. We saw it again during the dot-com bubble, before the bust of the dot-com bubble, meaning that these market bubbles and rallies usually start with the Dow Jones or the NASDAQ rallying first, reaching bubble territory. Then you see the Russell playing catch-up and outperforming the NASDAQ and the Dow Jones at the end stage of the bubble. Are you paying attention or not? Moving on to the whole fiasco with Trump being banned from Twitter. And of course, the downside to that is we're not going to have any more market top indicators. Remember, every time President Trump brags about the stock market, that is an opportunity to short and take your profits. Every single time he brags about the market, it goes down. So we're not going to know that anymore because Twitter decided to ban the President of the United States from the platform. After a close review of recent tweets from @RealDonaldTrump account and the context around them, we have permanently suspended the account due to the risk of further incitement of violence. You think they're banning Bin Laden's account here, but the damage was already done to Mr. Trump. He's already banned from Facebook, Twitter, Google, Spotify, Snapchat, Instagram, Shopify, Reddit, Twitch, YouTube. Even TikTok is not giving him any love. Pinterest, I had no idea that he had a Pinterest page. The good news is that Mr. Trump is not banned from Pornhub or OnlyFans just yet. So maybe he will issue his next message on his Pornhub channel. But things get out of whack a little bit here, and I think big tech will come under fire significantly. Because here was what happened. Of course, Republicans, conservatives, the MAGA crowd decided to get out of Twitter and move to a right-wing social media platform called Parler. And of course, the assumption is that Donald Trump will create an account in Parler and start tweeting from there instead. However, Google decided to ban Parler from the store, the App Store. It did not take long before Apple removed Parler from the App Store. And here is the final knockout punch. Amazon reportedly kicking Parler off its web hosting service. So Parler is gone, it's dead, it's over. Here is the problem from a stock market point of view. This is an illustration that big tech is way too big. It is more powerful than the US government and the office of the President of the United States. They can not only ban him from the platform, but they can completely gag his speech. He doesn't have access to Facebook, he doesn't have access to Twitter, Instagram, etc. But even if he wants to create an individual app that is not going to be allowed due to the duopoly of the App Store in the smartphone market by Apple and Google. And I know what you're going to say, but the president can do a press conference. I'm aware of that. What about after that? Meaning that we completely gagged the free speech that Donald Trump is capable of and allowed under the US Constitution. Now, inciting violence is a different story, but he's not going to even be able to do regular speech anymore. What do you think Republican politicians will do from this point on? Because if big tech can completely ban and isolate Trump, the sitting president of the United States, they could be next. You bet the Republican politicians will do everything in their power to remove Section 230 that protects big tech companies, and they will address the duopoly of the App Store between Apple and Google, meaning that the regulatory risk against big tech companies will surge significantly. And if you think that you're going to buy these big tech firms and they're going to outperform again in the 2020s, think again. They're either going to be broken down or they're going to have limitations in their growth and perhaps more competition in the market. Now, let's talk about the other side of this, because it is a tragedy what we've seen last week on Wednesday with the mob attacking the Capitol, ugly scenes that shocked every American. But we are heading into a very dangerous period in this country's history. And I am afraid that all of this banning and canceling by big tech firms of conservative voices and others will fire back, not just from a financial or stock market perspective, but from a unity kind of perspective in the country. Meaning, we know that a woman died in the Capitol siege. She got shot, and the MAGA crowd and Trump's supporters are already grieving the death of this woman, and they want to avenge what happened there. This is a very dangerous situation, and when they see the big tech companies are banning their accounts, limiting their quote-unquote freedom of speech, these grievances could come out and be expressed in the form of violence. I'm very afraid that we're going to see a very dark chapter in this country, the likes of the aftermath of Waco and the Oklahoma bombings in the 1990s. This is a very dangerous situation, and I sure hope that we will find some way of dialogue instead of banning and canceling. But this is what it means from an opportunity perspective in the stock market. And I hate to do this, but we're here to make money. Here is the NRA, which is a very powerful organization here in the United States that advocates for guns ownership. They posted the Constitution, we the people, etc. And then they issued this tweet. Only after all our guns have been banned, all our words have been censored, all our history has been erased, all our freedom has been taken, would they finally understand why we fight so hard to protect our rights to keep and bear arms. Oh boy. The consequence here is gun sales will surge like you have never seen before. What does that mean? Smith and Wesson stock will surge to extreme highs. This is going to be the next Bitcoin. You see, the stock already surged higher since the election of Joe Biden as the demand for guns increases. And now that we're going to have the inauguration of Biden, and we saw what happened in the Capitol and all the censoring that took place from big tech after, you bet that a huge slice of this country will go and buy guns like crazy. This stock will surge higher and higher. It already made the resistance of 23.5 this week, but my take is we will see another attempt to break 23.5 and perhaps trade meaningfully above that level. More upside for Smith & Wesson stock here. I hate to do it, but again, if you're looking for an opportunity from all of this chaos, here it is. Moving on to corporate specific news, starting with Boeing. Boeing agrees to pay $2.5 billion to settle criminal charge over the 737 MAX crashes. Now, if you think that Boeing is out of the woods and you can buy the stock now, forget about it. Because we had another plane crash over the weekend in Indonesia, and that will probably affect the stock negatively. Moving on to EV news, and we have more details about the upcoming iCar from Apple. Apple held talks with Hyundai Motors about cooperations on driverless electric vehicles, the South Korean car giant said, and you saw Hyundai stock rallying double digits upon hearing this news. So apparently the iCar will be the most expensive Hyundai ever produced. And here is more. Are you excited about how Ford butchered the Mustang? Because here it is. Wall Street analysts love test driving the new Mustang Mach-E, I think that's how you say it, and say it could be bad news for Tesla investors, aka the souffle. Again, I think that the Mustang should be sacred and they should not butcher it by making an electric vehicle called Mustang, but Ford has been underperforming as a stock and they need new excitement. What is a better way than to use and leverage the most recognized brand into the EV mania? So again, Tesla culties, keep telling me that Tesla is a monopoly and they're going to have a huge market share. No. The competition is already here, baby. You're just too blind to see it. You bought a lottery ticket, and that lottery ticket will have a drawing soon and only one winner. And that winner is Elon Musk. The rest will lose. Moving on to the last bit of EV news I got for you for General Motors. And GM decided to change the logo. And what they did is they paid a bunch of 12 years old interns to change the coloring and use Microsoft Paint to clean up the logo just a little bit. Now, General Motors is notorious for their horrible designs. Their cars couldn't be more ugly than they already are, and now they issue a new logo that makes you think, hey, couldn't they hire better interns here to do a little more professional job for the new logo? But that doesn't matter. General Motors, we heard from the results for the fourth quarter, and matter of fact, for the entire year of 2020. So let's review those very quickly. And here is the message, by the way, for Mary Barra. And don't get me wrong, I am GM's biggest fan. I bought the stock back in the summer, last summer, and everybody told me on Twitter, you're going to lose money, you're stupid, GM is dead, etc., etc. Well, guess what? The stock is up over 60% since then. But the message for Mary Barra is your company has a lot of redundancy and a lot of garbage, aka fat, that need to be trimmed. Case in point, take a look at the Buick results. There are cars that are not selling at all. Down over 90%, down over 70%, down over 60% year over year. That is significant damage in sales, and they need to address, do we really need all of these models, all of this redundancy? No, you do not. But here it is, Buick sales. Year over year, for last year, they were down 21.4%. In the fourth quarter, however, and please pay attention here just so you can understand why General Motors stocks have recovered since the summer, because it was looking forward to the fourth quarter results. In the fourth quarter, Buick was only down about 10%. What about Cadillac? Year over year, Cadillac down over 17.1%. For the fourth quarter, it is up 5.8%. Thanks to the XT6 model, this is the new SUV from Cadillac. The sales for this particular SUV for the year jumped over 95%, meaning they doubled the sales for this particular model. But take a look at the redundancy here. You got the Escalade, you got the XT4, XT5, XT6. There is a lot of fat to trim here, Mary Barra. And let's move on to Chevrolet and see how they did. Chevrolet down 11.2% year over year, however, up 4.6% for the fourth quarter, usually the second most important quarter in the year for car sales. And the best performer here is, no surprise, the Silverado. Pickup truck sales have been on fire. But again, look at the redundancy in the fat that could be trimmed here. You have all the Malibu, the Impala, all that garbage needs to go. They need to concentrate on the best performers instead. What about GMC, the last brand for General Motors? Down 8.8% for the year, but up over 10.4% for the quarter. So you're seeing how General Motors is turning the tide here during the fourth quarter, and perhaps more recovery to come in 2021. And by the way, GM sold more cars last year than any car manufacturer. But here are the results for GMC. The best performer is, again, it is a no-brainer, pickup trucks. The Sierra up 23% for the year, up 38% for the quarter. Moving on to the heat map analysis, and let's see what happened during Friday. We are mostly seeing rebound activities in some of the biggest losers for the week, but we did not have a definitive theme on Friday. When we take a look at the technology sector, you see profit taking in the outperformers like Taiwan Semiconductor down over 2%, but we see short covering / bottom picking for some of the names that underperformed significantly throughout the week, such as the software names. What about communication services? Muted action across the board. The notable loser here is AT&T, down significantly on Friday. When we shift to consumer cyclicals, again, rebound names such as Alibaba, Wayfair, Carvana all did very well on Friday. And of course, the mania in Tesla goes on. NIO was losing big on Monday. Option traders, of course, saw that as an opportunity to stampede and buy call options. You see NIO finishing over 8.5% for the session on Friday. The underperformers here are from residentials. We talked about DR Horton, Lennar, Toll Brothers. Matter of fact, I have a short trade for DR Horton, a put options trade that will expire this upcoming week. We called the top for DR Horton the Head and Shoulder formation. Since then, the name has declined significantly. Moving on to consumer defensives. What do we see here? A rebound day for Coca-Cola after the massive declines earlier in the week. And you also see rebound for the education names. They were down significantly throughout the week. We're talking about TAL Education closing over 4% on Friday. So again, it is short covering / rebound day. Similar story for REITs. Utilities, we see American Tower up over 2%, Public Storage up over 2% on Friday, NextEra Energy up over 2%, American Water up over 3%, shorts taking profits, and longs picking up the bottom. What about basic materials? More pain for gold here, but we also saw muted action for the hottest names, Freeport McMoran and copper, Valley, and I do see more declines here for the inflationary trade that worked last week. Materials will go down, industrials will go down, energy will go down. We'll see what happens. But for now, let's move on to industrials. You see that Friday brought pain to some of the hottest names throughout the week, such as Deere, down about 2% for the session. Now, we see defense contractors such as Lockheed Martin and Northrop Grumman down on Friday. They've been down all week. Massive weakness for these names, and expect them to continue, along with Boeing due to the news of the crash over the weekend. But we also saw significant declines for Triple M, Honeywell, Eaton, Emerson. The only outperforming sector is railroads, led by Union Pacific, up almost 3% for the session. Moving on to energy. The two giants of Exxon, Chevron managed to close in the green. The smaller names, not so hot so, closing in the red. And again, if you are playing the inflationary trade, the decline of the US dollar, you gotta stick with large multinational producers. If you put all of your eggs in one basket of domestic producers because you're looking for high beta names, be careful what you wish for here, because the likelihood is that the Biden administration will put limitation on fracking and the production from the US. So you want to stick with Exxon, Chevron, Conoco, Royal Dutch, but my favorite name is British Petroleum. British Petroleum was up over 2% on Friday. What about healthcare? Again, we see gains for Regeneron, Vertex in biotech. Moderna down 2%. Usually we see Moderna higher, Regeneron and the rest of biotech down, and then when we see those names higher, Moderna goes down. Notable activities here for Thermo Fisher rebounding from the recent declines, closing in the green, up over 2 percentage points. Moving on to financials. What do we see here on Friday? Rebound day for PayPal. They're buying the dip on PayPal. The moment we saw declines on Monday, that is bought right away. Meanwhile, again, we're talking about the reinflationary trade here, showing signs of weakness on Friday, which I'm betting will continue this upcoming week. Financials down just slightly, not by much. Bank of America down 1%. Regionals down overall. So you got to keep your eyes on how the inflationary trade is going to perform this upcoming week. Let's contrast that with the heat map for the week. And right away, you can see that the inflationary trade, we're talking about energy, industrials, materials, financials, even the semiconductor names, outperforming significantly. The big tech, software, momentum names, not so hot so this week. That doesn't mean, by the way, they're going to outperform next week just because we're taking profits from the inflationary trade. The market as a whole could go down because remember, big tech is under fire from the recent events. The notable losers throughout the week, we have Netflix down over 5%, Coca-Cola down over 6%, due to the investigation from the IRS. REITs down big, and we have the shipping giants and industrials, UPS and FedEx, down over 5% apiece. And of course, we talked about the defense contractors, Lockheed Martin, Northrop Grumman, down over 5% apiece. Let's check on the weekly heat map for the ETFs in the market. Right away, you see that energy ETFs such as the XLE, XOP were overperforming. So did financials, specifically the KRE that tracks regional banks. Yields go higher, regional banks do better. Similar story here for consumer cyclicals, materials, the XLB, the XME, all outperforming along with small caps, IWM, IJR. It's exactly what we talked about in the scenario that the Democrats win the Georgia elections and capture control of the Senate. That doesn't mean that technology and momentum ETFs declined significantly. Matter of fact, they managed to close in the green, yet underperforming the inflationary trade. And you see that the VIX proxies, the VXX, UVXY held strongly here. We saw massive gains in the stock market. Meanwhile, VXX only down 2.6%. UVXY, which is a high velocity one, down just a little over 4%. In the international markets, we see that emerging markets and Asian markets, specifically the Korean and Taiwanese market, we're talking about the EEM, that's the emerging market, and then the EWY, that's the Korean market, and the EWT, the Taiwanese market, all outperforming along with the inflationary trade. Perhaps the most notable take here from this map is the decline of the TLT, the long end treasury bonds. TLT down over 4%. I think it's a little excessive, and we will see dip buying in bonds here, which will push yields a little lower and push the inflationary trade lower this upcoming week. Moving on to the rotation trade. Any theme here? Not really. It was the tide that lifted all boats. Beginning of the week, we saw the reopening stocks, small cap stocks outperforming, and then as the week progressed, we saw dip buying in tech and momentum names, and they joined the party too. All in all, positive week for both sides of the rotation. But it is notable that you can see in the momentum trade, the big tech is lagging. Facebook, Microsoft, Apple, Netflix, Amazon, exception is Google, of course. And what's outperforming is DocuSign, Zillow, PayPal, Peloton, Zoom, Tesla. The hottest momentum names are outperforming. Big tech lagging. Very notable here. Across the aisle, you see that the cyclical trade, specifically the inflationary trade, is what outperformed this time around. We're talking about oil. Chevron up over 7% for the week, but it is very interesting that we did not see a surge higher from airlines and other reopening names, even though the likelihood for more stimulus has increased. Moving on to the charts analysis, and let's see what's going on. Starting with a chart of the S&P 500 futures, a continuous contract. And the reason why I'm showing you this particular chart is we've been consolidating, building up energy, trying over and over and over again to break above the upper limit of the consolidation range, and we finally cracked it on Thursday, and we had a confirmation on Friday. Looking at this chart, can you be bearish at all? No, you cannot. You read the chart as is, and as is says the chart is on a breakout. It is bullish. Now, once in a while, we see a fake breakout, aka a bull trap, breaking above a certain consolidation range, a resistance line. Everybody feels safe. They hop in the long end of the trade and they get caught, and you see a failure going back under the resistance line. In this case, the upper limit of the range. But we are in the trading business. We're not in the psychic business. So we're not going to place trades assuming that this is a fake out or bull trap until we see a reversal. Absent of that, the chart remains bullish. And by the way, the bullish scenario here is that you're going to go back, check the upper line of the range that you just broke out of, make sure that it is solid support, and then bouncing higher. That would be extremely bullish for the market. But going back to the yellow line, the upper limit of the range, failing and breaking below it, that is your bearish confirmation. Bulls look for a bounce, a retest, and then a bounce. Bears look for a revisit to the upper limit of the range and a failure after that. I think I'm clear here. Moving on to the chart of the triple Qs, the NASDAQ. We are in a new upward trend coming out of the consolidation we saw since September all the way to November, the elections. After that, we're building a new trend higher. Now, pay attention that every time we diverge higher from the trend, we have to go down and revisit it. We diverged by the tune of 2% to 4% in the past. Now we're diverging to about 1.8%, meaning that there is more room for the NASDAQ to go higher. But going over 2% divergence from the line will mean a risk of going back to retest the support of the trend line. Moving on to the IWM small caps. What do we see here? We talked about bull traps. Here was a bear trap that happened this week. Earlier, we saw the IWM flushing downward, and then what do you know? Recovering right away, blasting impulsively higher. Does this chart tell us anything? Not at all. It tells us that the IWM is trading at all-time highs. The sky is the limit. We're seeing positive curling in the MACD, not so much in the RSI, meaning the momentum is pretty much the same. We're not seeing an increase in momentum, even though we made a new, fresh all-time highs. You can't make any conclusion one way or the other looking at this chart alone. So here's what we do instead. We're going to look at the big brother of the IWM, and this is the Russell 2000, the ticker RUT. What do we see here? Breaking the trend, impulsively going higher, and recapturing the trend line once again. However, we're seeing negative divergence in the RSI, signaling a loss of momentum. Is it significant? Can it tell you one thing or the other? Not really, but if we do see another breakage of the trend line this upcoming week, that will be your confirmation that the Russell is getting weaker and losing significant momentum to keep the trend going. What about the smaller brother of the IWM, the IJR? We see somewhat of a bearish engulfing candle from Friday's activities. The IJR was down more than the IWM and the Russell. We see a negative curling downward in the RSI. Meanwhile, the MACD continues to say that we are in an upper trend. But remember, the RSI is a leading indicator. The MACD is a lagging one. So what are we looking for this upcoming week regarding small caps? Number one, we're looking at the IJR and we're looking at the gap at around 92. If we go down there, we want to see how the market is going to react. If we go down there and then close below, that would be a massive bearish signal. However, going back there, revisiting the gap, closing the gap, and bouncing higher, I would tell you that the rally is not over in small caps, at least in the IJR. Similarly, if you're looking at the RUT instead, you're looking for breaking the trend once again. If we do that on Monday throughout the week, that would tell you we're running out of steam. This is not going to make it to capture the trend once again. Look lower for further support. Moving on to the Dixie, the dollar index. What do we see here? The upper trend is getting stronger. Take a look at the MACD, the RSI, capturing momentum. The next resistance is 90.5. I think the dollar index will break above it, and we will see a significant surge for the US dollar here due to short covering. Just take a look at this chart and tell me what you see. The net USD positioning, the US dollar. Asset managers are shorting the US dollar to extremes, meaning that the risk here for a fire back and a short covering rally is very real. Moving on to gold. Gold got a whack on the head on Friday, significant one. And I told you, be careful of what gold is saying. Gold has been very mature in the movement, not going impulsively higher and actually going lower, predicting what's about to happen in the US dollar. And I told you that I bought gold at the support level of 1800 and I exited at the resistance level of 1925. If we go back to 1800, I will consider picking up more gold. But let's see how the dollar index is going to behave this upcoming week first. Moving on to the TLT, long end bonds. We have a descending line, and every time we break below it and we think that this is it, more downside for the TLT, what do you see? You see a bounce back and going back in range. We saw that at least once during November. Is history is about to repeat itself here? Are we going to see the TLT recapturing the range? I think so. I think the TLT is oversold at this point. We will see a bounce in bonds. What about the TNX, the 10 years Treasury yield? Massive rally since the beginning of the year, and it is time to hit the brakes, perhaps go back to retest the support of 1% and then bouncing higher. What does that mean? It means that once again, the inflationary trade could retreat so long as the TNX is diving lower to retest the support of 1%. We could continue to go higher and higher. That is on the table. But at this point, we're overextended. We need to go down and revisit the 1% support once again. What about the VIX? I showed you this wedge-ish formation and it is evolving by the day, but it is abundantly clear now that we are at the lower end of the wedge. And if we break below the wedge, that will be significant weakness in the volatility index. You're already seeing a loss of momentum in the RSI. So once again, it is a very critical week for the VIX. If we are looking for a further surge in the US dollar, decline in inflationary trade, perhaps more pressure on big tech, this is a recipe for the VIX to rally. The VIX is still within the wedge range. It is looking a lot weaker now, but I maintain my position that we will see another surge higher in the VIX before the end of the first quarter. Moving on to Apple. Let's see what's going on here with Apple from a different perspective. We have seen since the September top a new trend emerging. Higher lows, and we went all the way back to retest the top from September, creating the double top formation. Are we about to gather more energy to make all-time highs, or is there more declines to come for Apple here? Let's take a look at how the trend performed since the top in September. Every time we diverge impulsively higher, we have to go down and revisit the trend line. We had a divergence back in October to the tune of 18.5%, and we went down revisiting the trend line. What do we see now? We had a divergence last month of over 18.5%, going all the way to all-time highs and then retreating. I see Apple going back to retest the trend line at least. And by the way, pay attention to where the RSI is. There is a significant loss of momentum in the name here. Moving on to Tesla. What's going on here? This is the story of the week, the story of the year. It's been going on for a while now. But the rally we've seen so far is perhaps one of the largest we have witnessed in Tesla's stock history. But remember, every time we saw an impulsive rally in Tesla, we saw either consolidation after that or a significant correction. Case in point, back in the summer, after the stock split mania, we saw the name rallying significantly, only to go down in a double digits correction. We have another mania here, another rally. You can call it the S&P 500 inclusion rally. You can call it the STIMI rally, buying all these call options to insanity. It doesn't matter. Moral of the story is the stock is going to face a correction imminently. And remember, my line in the sand is the RSI level of 84. We are now at 83 and change. Close enough. Meaning that as soon as Monday, I will deploy a short trade against Tesla via put options. Now, the bullish scenario for Tesla is to go down to the same resistance upper limit of the range trend line that's been battling for a while, retest it for support, and then blast higher. If that doesn't work, perhaps going all the way to 599 and then bounce higher. Breaking the trend line, then breaking 599, that will be the ultimate bearish signal for Tesla. So you have to watch out for that. I got a question on my Twitter page whether I'm shorting Tesla via options or short selling the stock. Short selling the stock at this point is very, very expensive because if you want to short sell the stock, you got to at least short 1,000 shares to make it worth it, meaning that it will cost you over $800,000 plus you got to put about $200,000 to $300,000 worth of margin reserve because this is a very volatile stock. So you're going to commit over $1 million of your portfolio for this trade alone. What if the stock doesn't decline right away and we see more gains? Now you have your money locked up in this trade. You cannot make any other trades. This is why I'm doing it via put options first to define the risk. And by the way, for the skeptics that Tesla only goes to the moon and there are no corrections, bro, go back earlier in 2020. Tesla had an impulsive rally to the upside, granted, but it also had over 65% correction. The stock went down 65%, lost more than half of its value. That could happen again easily with the current extension in the stock. So what are we doing here? Here is the bearish trade that I'm looking at. Number one, I'm buying the 600 puts. That is around the support line of 599. I am buying expiration date February 19th. I am paying about $12 a piece to enter this trade. At the same time, I am selling the 600 puts, expiration date January 29th. I am capturing about $5 for this trade to lower my entry trade. The third leg of this trade will be selling the 500 puts, expiration date February 19th, meaning that this is going to be a calendar put debit spread hybrid. Now, the likelihood is your broker is not going to let you do that unless you have a lot of money to cover for margin and collateral. What your broker is going to allow you to do is start two legs of the trade first, meaning you'll buy the 600 puts expiration date February 19th, and then you're going to sell either the 500 puts expiring February 19th or the 600 puts expiring January 29th. The way I'm doing it is buying the 600 puts expiration date February 19th and then selling the 600 put January expiration 29th, meaning that I'm starting with a calendar put. And then as the stock continues to decline, perhaps if we reach January 29th expiration and we are trading at 720, 680, etc., the 500 put will appreciate significantly in value, meaning that by the time you sell the second, or in this case the third leg of the trade, the 500 puts expiring February 19th, you will probably capture more credit than 5.5 that you see on the screen right now. You'll probably capture $8, even more than $10. All in all, you're gonna get to a point where you actually got paid for this trade, meaning that at that point you could give a rat's ass whether the trade is gonna work or not because you got paid to enter the trade. I know it sounds complicated, but it's not that complicated if you're an experienced option trader. If you're not, I understand, that's totally fine. But if you are been trading options for a while, I think the structure is very clear here. And even if you do it all together on the same time and you sell the 500 puts expiring February 19th for the price you see right in front of you, about $5.50, your total entry cost is about $1.50. Meanwhile, your profit potential of Tesla collapses all the way back to 500. Remember, they have earnings in February. If the name collapses all the way down to 500, your profit potential is massive. It is $100 a piece. You're investing $1.50 with the potential to make 100. If you do it the way I'm going to do it, you're going to get paid to enter the trade, and then your maximum profit potential at $100 per option. Enough said. Now, let's move on to discuss a trade for Tesla shareholders. Perhaps you're looking at the chart and you're saying, oh, the stock rallied significantly. I'm afraid of a pullback. Should I sell all my stock? Should I sell some? What should I do here as a strategy? Here is what you do. And this is, of course, assuming that you own 100 shares or more in Tesla stock. You cannot do it if you own less than 100 shares. Very important. You are going to sell the 1,000 calls expiring January 22nd, and you are going to get paid $20 a piece or $2,000 per contract. And you are going to buy the 600 puts expiring February 19th, the same one that I'm buying for the bearish trade. And you're going to pay about $12 a piece or $1,200 per contract. All in all, you are going to get paid for this trade. Again, you're going to get paid for this insurance policy. Are you stupid enough not to take it? You're going to get paid $8 a piece or $800 per contract if you do this trade. And the beauty of this structure is that, let's say Tesla declines significantly, it goes down to 700, 600, even below. That 600 put will appreciate significantly in value, and you can capture your profit and close that trade at any time you please to lock in your profits. The only downside to this trade is if by January 22nd expiration Tesla finishes above 1,000, guess what? You're going to have to sell your shares for $1,000. Is that bad? No, it's not. You're still making a you-know-what amount of money. $1,000 a share is beyond your expectations. Let's be honest here. But the beauty again in this structure is you're capturing a lot of value from selling that call option, and the likelihood is Tesla will not finish over 1,000 by January 22nd. It will have a correction. So you're almost guaranteed here that you're going to capture at least $20 a piece in credit. And then you let the 600 put accelerate in value. You can sell it at any time you're satisfied with your profits. It's pretty much risk-free, assuming that you have 100 shares or more in Tesla. If you have 100 shares, you can sell one contract. Got 200 shares, you can sell two. What you cannot do is, if you have 100 shares, you sell two or more contracts. Again, please, if you're not familiar with options trading, do not follow these trades. Only follow them if you understand what I'm saying here and you are experienced in options trading. Enough said. By the way, before we move from Tesla, here is Michael Burry. Big short investor Michael Burry predicts Tesla stock will collapse like the housing bubble. Quote unquote, enjoy it while it lasts. Again, you think you're smarter than this guy? This guy has been trading, investing in stocks since you were in diapers. Maybe you should listen to him and follow the trade I gave you to protect your shares from further declines. You're getting paid for the insurance policy. Now, before I finish this video, I really had a lot of charts for you to share from Amazon, Airbnb, Snowflake, BlackRock, a lot of charts that I'm watching this week. But this video is very long already, so let's wrap it up and do the conclusion of the video, and then perhaps release another video in the morning for charts that I'm watching this week. We're done with the Georgia elections. The Democrats won, meaning stimulus, optimism surged higher. And we saw right away that the yields for the 10 years Treasury yield climbed significantly higher, igniting the inflationary trade to go higher further. We're talking about oil, materials, financials, industrials, etc. But we also saw dip buying for the big technology names and the momentum names. All in all, the market did very well. It ignored the warning signal from the rise in yields. They decided to buy the dip in tech and momentum rather than fading it. What do we see this week? Bitcoin is already showing somewhat of a topping formation, declining about 7% last time I checked. Bitcoin has been a very good indicator for what's going to happen to the stock market. When Bitcoin surged higher, the market did as well. Bitcoin is retreating right now. Will the market follow? I think so. The dollar is likely to surge higher this upcoming week, meaning inflationary trade will suffer. Furthermore, the whole scrutiny on big tech now that they banned the president and they have too much power, that will come into the front line and will add more pressure on the tech names. Similarly, we will see a decline in yields. That is my read, of course, for the week, my outlook, that we will see a decline in yields after the massive move last week, meaning we could see banks suffering as a result. And then we have bank earnings on Friday from JP Morgan and Wells Fargo. Let's say that the results are decent, then it will be a dip to buy in a name like JP Morgan. But for now, my outlook is we could see a retreat here in stocks this upcoming week. If my outlook is right and we see the dollar index surging higher, yields going lower, and the scrutiny on big tech take center stage. That's all I got for you for now, and I'll talk to you again soon. If you found the information presented in this video helpful, please subscribe, press the like button, the notification button, and follow me on social media.